Star Shoes is a combination of IS1 question with the company's and statement of changes in equity. Associated with that, I'm not going to do this income statement. I'm only going to do all the share transactions and share related transactions in this question. You can work through the income statement in your own time and make sure that you understand how the expenses are grouped and where the figures are coming from. So Star Shoes is a company that buys and sells a wide range of shoes, but also does repairs for its customers, for which a fee is charged. Unfortunately, the accountant fell ill recently, and as usual, you come to the rescue. The following information was given to you. Star Shoes pre-adjustment trial balance as at 31 October 23. Now let's just quickly move to the required part. Prepare the statement of profit or loss and other comprehensive income for the year ended 31 October 23. So they gave us the preliminary trial balance as at year end. And then prepare the statement of changes in equity. I'm going to talk about that one. And the third one, I'm not worried about VAT. You can work out VAT in your own time. SARS dividend withholding tax. I will tell you what is the amount outstanding as at 31 October 23. So let's just quickly have a look at the preliminary trial balance. They had ordinary share capital of 90,000 shares, 12% cumulative redeemable pref shares capital. Cumulative compulsory redeemable pref share capital of 250,000. They had retained income. They had a revaluation reserve. Then they had all kinds of funny things. And then that's something that has something to do with your shareholders. There is on your trial balance shareholders for dividends, 255,000 Rand. And then a lot of income statement items and a few other statement of financial position items as well. The authorized share capital consists of the following: 200,000 ordinary no par value shares, 20,000 10% convertible preference shares of R3.10 each, and 50,000 12% redeemable. Just want to add the word compulsory. It doesn't make any difference in your life at this point of time, but come your third year, that is going to be quite important to see the word compulsory. If you see redeemable cumulative preference shares, you know that you have to treat it as loan capital, and it was no par value shares. Then you have to read carefully here. Additional information that has not yet been taken into account as at 31 October. So none of these additional information is included in this trial balance. Now, number one, during the previous financial year, the year ended 31 October 22, a dividend was declared but not yet paid. The tax portion of the dividend was, however, already paid to SARS in the 22 financial year. During the current financial year, the directors decided to pay a portion of this dividend by ways of a capitalization issue of 12% cumulative redeemable preference shares. Now we treat this as loan capital, the redeemable pref shares. But that is not to say that there isn't a share certificate. It is not to say that the 12%, according to the share certificate, is the dividend attached to that preference share. The only thing that is different is that for accounting purposes and for tax purposes, we treat this as loan capital because the nature of that share is of a loan nature and not of an equity nature. And that is the reason why we treat it as loan capital. But nothing prevents the directors to issue more of these shares should they wish to do so. So on 1 March 23, that is the date. Very important though. They still haven't paid that dividend to the shareholders, and they have decided that 50% of the dividend is going to be paid by issuing 12,000 12% cumulative redeemable shares to the shareholders, and the other 50% was going to be paid in cash. Now, what is important here is that we determine here. Nowhere did they tell you what was the dividend that was declared. But they don't have to, because in effect they have already told you. They've told you that shareholders for dividends, because none of these things in points 1 to whatever, 12, is in the books as yet. Now, let's just highlight that one as well. All shareholders are natural persons. Now, if we have in 22 already paid the receiver of revenue, what is the percentage of dividend withholding tax that we have to pay the receiver? 20%. So if there was still shareholders for dividends on our trial balance of 255,000, what portion of the dividend which was declared in 22 does the 255,000 pertain to? Guys, that must be the 80%. 20% has been paid. But the total dividend was not 255,000. This is the amount that we still owe the shareholders in respect of the 22 financial year. So that is just the starting point to find out how much was the total dividend which was declared in that year. So let's look at it this way. 255,000 equals 80% of the total dividend which was paid. So the total dividend which was paid was 318,750. When this dividend was declared in the previous financial year, what was the accounting entry that they've posted in the books? They debited in the previous financial year dividends, cum retained income, 318,750. They credited shareholders for dividends with 80%. Oh, there. And that was 255,000. And they credited SARS, dividend withholding tax, 63,750. And then they even went further and they paid SARS. So they debited SARS 63,750 and they credited bank 63,750. Now that payment is water under the bridge. I cannot do anything about that. And SARS has already said, well, I'm not going to pay you back any dividend withholding tax. If there was a mistake and you've paid me too much money, then you have to wait until the next date of dividend declaration. And then I will give your money back. You can offset that amount that I owe you for overpaid dividend withholding tax against the dividend withholding tax, which is payable at a later stage. And then you can only pay me the difference. So therefore, they're not going to repay me any amount. Now let's have a look. If we have dealt with this 318,750 from the start of the way that we are now intend to settle that dividend. We intend to settle that dividend with 50% as issuing redeemable pref shares. 50% of that amount, 159,375. The other 50% will be paid in cash. Now, dividend withholding tax is only applicable on the cash portion of a dividend which is paid. So that 159,375, I was only supposed to pay SARS 31,875, and I'm going to pay 80% to the shareholders, 127,500. I have paid SARS 63,750. I was only supposed to pay SARS 31,875, so I have overpaid SARS, the difference between the two, which accidentally is also 31,875. Now, if we're going to pass that entry in our books now, and we're going to settle this dividend now, what is the entry going to be? Well, obviously, we want to take the 255,000 out of our books. So we're going to debit the existing shareholders for dividends with 255,000. We are going to debit SARS with the amount which we've overpaid him, 63,750 less 31,875, which is also 31,875. We're going to credit the redeemable pref share account. And please note, statement of financial position, it is a loan account, 159,375. It does not appear in the statement of changes in equity. And then we're going to pay the shareholders, pay the shareholders the amount that we should pay them, 127,500, 127,500. And then your journal entry will be in balance. So let's just go to the redeemable pref share account. The redeemable pref share account will start off with an opening balance as per your trial balance of 250,000 Rand. 12% cumulative compulsory redeemable pref shares, 250,000 Rand. Then the cap issue. We've now just done the journal entry and we said we're going to credit this account with 159,375 as at the 1st of March. So now the balance on that account is 409,375. Let's quickly start also with our statement of changes in equity. Now, a statement of changes in equity will open up with these figures. 90,000 ordinary shares, 1,650. Ordinary share capital, opening balance, 1,650. And I just want to add here 90,000 shares. Great. Then if you go back here, we say that one does not appear in our statement of changes in equity, minus 5 marks. Retained income, 461,870, and we have a revaluation reserve of 25,000 Rand. Retained earnings, 461,870, revaluation reserve, 25,000 Rand. Great. Now we continue. Number 2. On 30 June 2023, well, guys, dates are very important. The directors decided to redeem 30% of the 12% redeemable cumulative preference shares. They're going to pay it back. To finance the redemption, I have to give them the money back for 30% of the value of those shares. I'm going to issue ordinary shares at the shareholders, at existing shareholders at 15 Rand each. So I'm not going to give them cash. I want them to give me, I'm going to issue ordinary shares to the value of 15 Rand each. So what is important is that I know exactly how much is my outstanding ordinary share capital. At that stage, my redeemable pref share capital had a balance of 409,375. If I work out 30% of 409,375, it gives me a total of 122,812. I'm going to give them shares. So therefore, what am I going to do? I'm going to issue them share certificates to the value of 122,812. So under my ordinary share capital, that's English, ordinary share capital, I'm going to issue additional shares on 122,812. How many shares am I going to issue to make up that amount of 122,812? And they tell me I'm going to issue those shares at 15 Rand each. So therefore, if I take the 122,812, I divide it by 15, it gives me additional 8,188 ordinary shares that I'm going to issue in order to redeem those preference shares. Going to pay it back. The asset disposal account is number 3. I'm not worried about that. You can do it in your own time. The same thing applies to number 4. Number 5. The managing director of the company had a brilliant idea for breaking into the toddler shoe market, but the project requires a capital input of 150,000 Rand. When he proposed the idea to the board of directors, they seemed very enthusiastic, but were a little concerned as to where the capital would come from. One of the younger members of the board remembered that the company has 20,000 authorized 10% convertible preference shares of 3 Rand 10 cents each, which have never before been issued. If you go to your trial balance, no convertible pref shares has been in issue up to that stage. If you go to your authorized share capital, you will see that we have 20,000 10% convertible pref shares of R3.10 each. So there's a par value attached to that of R3.10. After discussion, it was decided that these shares will be issued at a market-related price of R8 per share after they have been converted into no par value shares. Now, I haven't issued up till now any of these shares. So any conversion of par value into no par value shares cannot require any accounting interest because there is nothing that I can change. However, in the scenes at the back, there is going to happen quite a few things. The shareholders need to take a special resolution. The special resolution needs to be registered with the CIPC. The memorandum of incorporation needs to be changed. And after all this admin issues has been sorted out, then the company can go ahead and then it can issue no par value shares. So he's going to issue 20,000 no par value shares at R8 a share. The issue was finalized on 1 August 23, important for preference shares because why? The dividend is time-based at an issue cost of R5,000. And all 20,000 shares were issued to the public on this date. It is the policy of the company to utilize distributable reserves for the purpose of issue costs, so writing off the issuing costs. Great. So if we go back to our statement of changes in equity, because this is an equity instrument, we're going to issue 20,000 shares at R8 per share. So we're going to raise R160,000. Share issue cost, according to our policy, needs to be written off against retained earnings. So that R5,000 must be in the retained earnings column if you want to earn any marks for this entry. Then number 6, the company issued 9,500 ordinary shares on 1 October 2003 at R2.04 per share to finance the purchase of a new shoe shining machine, blah, 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 blah. I'm not worried about the new shoe shining machine. I'm worried about the issuing of the shares. Guys, please do not combine these two transactions. It's two totally separate transactions. I issued shares to raise funds. And then once I have the funds, I'm going and buy and whatever asset I'm going to invest it in. So it's two different things. Debit bank, credit ordinary share capital. Debit asset, credit bank. So don't try to combine the two. It's two separate transactions. So the one I'm interested in is this one. R9.50 or 9,500 shares at R2.04 per share. So 9,500 multiplied by R2.04 means that I've raised an additional 19,380 Rand. Good, number 7, I'm not interested in at this point of time. Number 8, land and buildings were revalued during the year by Mr. Didas, the sworn valuator on 31 October 23, right at year end, to R3 million. And no depreciation is provided on that. Now what is important here is that we determine how much was our revaluation for the current year. We revalued it at R3 million. What is the current value of our land and buildings in our books? Our current value for land and buildings, 2,417,500. So we further revalued. Remember, we also had an opening balance of 25,000. Where was that? There was that, 25,000. Now that's purely our opening balance. That has already been accounted for. For the current year, though, we have further revalued our land and buildings with an amount of 582,500. What is going to our income statement as other comprehensive income? Only the movement for the current year, 582,500. And that was going to be posted as part of other comprehensive income to the statement of changes in equity as well. So I just want to show you in our, where is it? In our statement of profit or loss and other comprehensive income, there is the second page of it. Other comprehensive income, gain on the revaluation of land and buildings, 582,500. And in our statement of changes in equity, other comprehensive income under the revaluation reserve, there we will show the 582,500. Number 10, the shareholders approved a final dividend on 31 October of 90 cents per ordinary share. All shareholders are natural persons. Good. Now, we know that if we have declared an ordinary dividend, it means by implication that we have also declared all the preference dividends. So let's quickly go and determine what was the ordinary dividend as well as the preference dividend as well as the interest that we have to make provision for in the current financial period. Ordinary dividend, and now it's easy because I've got all my information. 90,000 plus 8188 plus 9,500 multiplied by 90 cents gives us an ordinary dividend of 96,919. If we go to our pref shares which was issued, it was issued on the 1st of August this year. So from 1 August to 31 October, is August, September, October, 3 months, 160,000 multiplied by 10% multiplied by 3 months gives us a pref dividend of 4,000. So total dividends for the year, 100,919. So dividends, reduction of retained earnings, 100,919. But let's go and have a look. What is the finance cost that you have to make provision for in your income statement? Now that will be based on our redeemable pref shares. On 1 November to 1 March, the outstanding balance was 250,000 Rand. So from 1 November to 1 March, 250,000, the dividend rate was 12%, and 1 November to 1 March equals 4 months. So for that period, it was 10,000 Rand. For the next period, it was 409,000. That was the total outstanding capital up to when? Up to 30 June. That is when we have actually issued ordinary shares in return for 30% of the redeemable pref shares. So 409,375, there it is, multiplied by 12%, that is also for a 4 months period, and that gives us 16,375. And then we have exchanged some of these pref shares for ordinary shares. So then, as from the 1st of July up to the end of October, the financial year, our outstanding balance would have been 286,563. 286,563 times 12% is also 4 months, 11,463. So our total finance cost, which equals the dividend on the redeemable pref shares, 37,838. And in our income statement, finance charges, 37,838. Well, then the only other thing that you have to do is to post our net profit for the year after tax. So here is our income statement. Let me just show you. Statement of profit, loss and other comprehensive income, store shoes, we had income, cost of sales, gross profit, other income, distribution cost, admin cost, other expenses. There were quite some calculations that we've done there. That's all calculations. And then we had finance costs. There was finance income, profit before tax. We had 28% profit on the profit before tax, profit for the year. And now you see that profit after tax of 582,998, that is then posted under retained earnings, 582,998. We've already posted the dividend, so that is in the books. We have already posted and showed you what you should do with the other comprehensive income. There's the 582,500. There's the 582,500. What was total comprehensive income? The 582,500 plus 582 998.